Welcome back to Survivanomics. I'm Sebastian, and today we're diving into Step 3, a banking structure that fills your bank accounts. It's all about a simple ancient method adapted for today to systematically grow your wealth. In ancient times, people used jars to manage their resources. Each jar had a purpose, one for living expenses, one for savings, one for charity, another for investments, and another that was a contribution to growth of the divine in the culture. We're going to adapt this system for our digital age and maybe scale it down to cover those starting in a state of greater struggle. I stumbled onto this ancient wealth building practice as I was struggling to move off my friend's couch post-separation. This system became my lifeline as I found a small bachelor apartment that would allow me to stay near to my kids, shuttle to casting offices, get to film sets, and hunt for moonlighting jobs. I had to make sure I had enough money to cover rent, the connection time for my kids, the legal costs of the family court system, and, if possible, investment capital for a better future. I began employing a smaller version of the jar system by instinct. I wanted to make sure no matter what happened, I would never end up on a couch again, and that I could always get to my kids. That's when I pulled out an envelope, wrote emergency rent and kid transport on it, and began putting 10% of every penny I made in it. Saving money in that situation seemed impossible, but car rentals and rent bills were something I had every month anyway, and I was making sure I had the cash ready to cover it, without stress. Of course, like most people, I also had a bank account where I would place the other 90% portion of my money. At the end of the month, if I had enough money in my main account, I wouldn't take anything from my emergency envelope if I didn't have to. I would pay for my main account and then just keep adding to that 10% envelope to cover more future months of rent and kid travel. Enough hard times were hitting me that I was bound to need the emergency rent and travel money at some point. Why not let the buffer grow a little? I was surprised at how fast the money in the envelope would grow. Even when court costs grew, and I did have to tap into it, there was more than enough to cover the rent, and the envelope grew even faster because I never stopped adding that 10%. If I got $100, I put $10 in the envelope without fail. Little did I know I had already begun using that ancient jar system, a system I would use in more expanded ways over time. So first, you need a minimum of 2 jars, with one being a bank account for your expenses, your operating jar, and another envelope or bank account being for your 10% emergency bill savings. Eventually, you will want a special savings bank account to place your excess emergency bill money into, assuming you let it grow to the point that it's not safe to have sitting in your house in an envelope. And this bank account will become your general savings jar. One step that I found made it easier to set aside the 10% emergency money in an envelope was to have a second envelope that I labeled cash float. When possible, I'd have $200 or $300 in cash in that envelope to make it easier to make small 10% transfers from that envelope into my emergency bill envelope whenever a payment came in. This meant I didn't have to run to the bank for my 10% emergency bill amount for every little bit of money that hit my regular bank account. I could also use this cash float when I needed for small amounts of cash for parking or cash-only transactions. As things leveled out a bit more, I started to see another jar or bank account that was needed. This was because at the end of each year, the tax man always takes a potential cut of any money we make, and if you can't find enough tax write-offs, you just may end up needing to pay a tax bill. Even if you don't have to pay a tax bill, you're likely going to be paying your accountant for the paperwork anyway. Why not avoid the shock of tax bills and set up an account that protects you? For this reason, create an account or jar called tax and investment savings, where you place 20% or whatever your tax bracket is of any gross potentially taxable income you receive. Now, this doesn't mean gifts, but again, anything taxable. Initially, don't even look at this as your money. It's just tax dollars you would have had to pull out of personal savings later anyway, were it not for you setting this aside. However, if you can get enough tax write-offs over the year and you don't have to pay that money, it all comes back to you as a bonus for you to invest as you please at the end of the year. Plus, those funds will easily cover any fees your accountant charges for doing your tax returns. Depending on how much you're making and what you prioritize, you can add more jars or accounts for specific goals like charity or donating to your church or synagogue. However, let's look at what we have firmly established for jars, envelopes, or bank accounts. Number 1, this is your main expense account or your operating account, which you'll deposit the majority of your income into and use for your living expenses. Number 2, this is your emergency bill envelope. Pick a monthly bill that is sizable and important to you and place 10% of any net dollars you receive into this envelope. Number 3, there is your cash float envelope, so you have access to cash when you need it. Number 4, once you have the above 3 covered, open your tax and investment savings account and place 20% of the gross dollars you receive from any potentially taxable income into this account. Every time you get income, divide it among these jars. It's about being intentional with every dollar you earn. For example, put 50% in your operating jar for your monthly expenses, 20% in your tax and investment jar, 10% in your emergency bill jar, and so on. Now I know what you're thinking. Sebastian, I barely make enough money as it is. But that's the beauty of this system. Initially, you aren't saving money that you don't have. You're just setting aside money for a bill that you have to pay anyway at the end of the month. If things are so tight that you have to use that money to pay the bill, then use it. You just won't have to worry about it coming from your operating account. But if by chance you can skip using the emergency bill money and pay from your main account, you've just made it even easier to pay that bill in the following month. As your situation improves, you gradually will use your emergency bill money less and less, and it will grow more and more. Essentially, by looking at these funds not as savings, but as emergency dollars for a bill you have to pay anyway, you trick your brain into a habit that results in being a saving, growing amount of money. Even small amounts consistently allocated can lead to substantial growth over time. It's not about the amount, it's about the habit. Try this for a month. If you can't match all the different money jars like the 20% tax and investment account, then start by just picking a monthly bill and creating your emergency envelope for that bill. Then just save 10% of anything you bring home toward paying that bill. See if you can avoid using that money at the end of the month and roll it over into the next month. As you get on your feet, set up the other jars and hey, let me know in the comments how it goes. What adjustments did you make? Any challenges or successes? I want to know. Remember, Survivanomics empowers you to take the reins of your financial destiny. Join me next time for Step 4, Investments and When to Move Your Money. We'll explore what to do with your money when you find yourself accumulating enough to invest and how you know you have enough to do it. And if you're finding value in this series, like, subscribe, and share. Spread the word and help others on their journey to financial freedom as well. Remember, fight the darkness, put truth in story. We'll see you next time.